School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit-3 Financial Statements, Part-3.
Balance sheet contents and classifications. Having understood the basic concepts and functioning of a balance sheet, let us now try to understand the contents of a balance sheet. We have already discussed that every transaction affects the financial statement of a business, but it is not feasible to draw up the financial statements after every transaction. Thus, financial statements such as balance sheet, profit and loss account, and cash flow statement are prepared at the end of a specified period, usually a year. This specified period is referred to as an accounting period or a financial year. As already discussed, the balance sheet prepared at the end of the accounting period reflects upon the position of the entity's assets, liabilities, and capital accounts on that specific date. To be able to read and analyze a balance sheet, you must understand its different elements and what they signify about the financial health of the business. An accurate understanding of the balance sheet enables an analyst to evaluate the liquidity, solvency, and overall financial health of a business. A balance sheet represents the assets, liabilities, and capital of the business in such a way that the accounting equation always balances. That is, assets must always be equal to the sum of liabilities and owner's equity. Now let us talk about these balance sheet elements in detail. Assets. Assets are resources of economic value that a business entity owns with the expectation that they will provide future economic benefit to the business. They are generally divided into two categories: current assets and non-current assets. The liquidity of the asset determines into which category it falls. Liquidity is the ease with which an asset can be converted or realized into cash. Those assets that can be converted into cash within 12 months are considered as current assets. For example, inventory, short-term investments, bills receivable, cash and bank balance, etc. Non-current assets, on the other hand, are the assets which generally cannot be converted to cash within 12 months and are normally used to run the business. These include fixed assets such as equipment used in the running of the business, furniture and fixtures, and also any real estate the business owns. Non-current assets also include long-term investments made by business and intangible assets such as goodwill, etc. Liabilities. They are obligations the business owes to outsiders. They are also divided into current liabilities and non-current liabilities. Current liabilities are obligations that are scheduled to be paid within a span of 12 months. Most common current liabilities include accounts payable, business line of credit, current installment of a long-term debt, provisions, etc. Non-current liabilities are long-term liabilities that are usually paid in more than 1 year. Usually, such long-term liabilities include debentures and bonds, borrowings from financial institutions and banks. The borrowings can either be secured or unsecured. Owner's equity. They represent the owner's residual interest in the assets of a company, net of its liabilities. That is, owner's equity equals to assets minus liabilities. It is also referred to as net worth of the business. In other words, owner's equity is everything that is left from the assets after paying all the liabilities. It consists of the capital contributed by owners and retained earnings of the business. We will discuss the constitution of retained earnings later in this chapter. Hence, the amount of equity is increased by profits earned during the year or by the issuance of new equity. On the other hand, equity is decreased by financial losses, dividend payments, etc. Assets, liabilities, and capital accounts are subcategorized in a balance sheet on the basis of their liquidity and to present a more meaningful and useful view of the financial position of the business. Whatever system of classification is used should be applied on a consistent basis so that balance sheet information is comparable over multiple reporting periods. Now let's discuss some common classifications used in a balance sheet. Current assets. A current asset is an item on an entity's balance sheet that is either cash, cash equivalent, or an asset which can be normally converted into cash within the operating cycle of business or within 1 year, whichever is shorter. An operating cycle is the duration of time it takes for a business to convert its inventory into cash. It includes the time taken in acquiring inventory, converting inventory to sales, and then recovering cash from trade receivables. The operating cycle starts with cash and ends with the collection of cash. Length of an entity's operating cycle is an indicator of its liquidity position and asset utilization. Common examples of current asset in order of their relative liquidity are cash and cash equivalents, short-term investments, for example marketable securities, accounts receivable, inventory, and prepaid expenses. Cash and cash equivalents. Cash refers to the currency, checks, or any other document that circulates as cash. It includes the cash kept in the cash chest of business and also the deposits made in current accounts with banks. Further, cash equivalents are the highly liquid investments that are readily convertible into cash and are subjected to insignificant risk of change in price. Examples include cash and paper money, treasury bills, money market funds, etc. Cash and cash equivalents are the most liquid form of current assets available for a firm's day-to-day operations. Short-term investments. It is advisable to invest excess cash held by a firm to generate additional income. It may be invested in financial instruments that can be quickly converted into cash like equity shares, debentures, and government securities. These assets are readily marketable and could be sold whenever cash is required. They are classified as current assets as these investments tend to mature within a year or less. Accounts receivable. Usually, a business entity sells its goods and services both in cash as well as on credit. Accounts receivable refers to the balance of money due to a business entity for the sales made on credit to its customers. It is also denoted as sundry debtors in the balance sheet. It represents the amount arising out of normal business transactions such as credit sales, and the credit period usually ranges from few days to months. In most situations, these accounts are unsecured and have only the personal security of the customer. In some cases, customers default and the payment may not be realized. These defaults in payment by debtors are called bad debts. Bad debts are recorded as an expense in the profit and loss account. Inventory. Inventory generally consists of raw materials required to manufacture the products, unfinished goods at various stages of completion, that is, work in progress, and finished goods, that is, goods ready for sale. Apart from these, there may be inventory of stores and supplies. Thus, we have raw material inventory, work in progress inventory, finished goods inventory, and stores and supplies inventory. It is also commonly referred to as stock in trade. It may be noted that the type of inventory may vary depending on the nature of business. For example, a manufacturing firm will have a combination of raw materials, unfinished goods, and finished goods as inventory, but for a trading firm, inventory will usually include finished goods available for sale. As a general principle, inventory is valued at cost. It implies that all normal costs incurred to make the goods available at the place where it can be sold or used are treated as costs of inventory. Prepaid expenses. Prepaid expenses are items which are usually paid in advance, such as rent, taxes, insurance, etc. For example, if rent for 2 months of the office building is paid in advance, then the business acquires a right to occupy the building for 2 months. This right to occupy is an asset but will expire within a fairly short period of time. Therefore, it is a current asset. Therefore, it is shown on the asset side of the balance sheet. Since these expenses are paid in advance, they become due in the next accounting period. Hence, they are not debited in the profit and loss account of the current period. Fixed assets. Fixed assets are tangible long-term assets used in the business that are of a relatively fixed nature. These include building and land, furniture, equipment, machinery, etc. Fixed assets are not expected to be consumed or converted into cash within a year. Instead, they are used in running business operations to generate income. The useful life of fixed assets is more than 1 year and they are capable of repeated use. Valuation of the fixed assets is usually made on the basis of original cost. However, the assets have a limited useful life and their value decreases over time due to use, wear and tear, or obsolescence. Thus, valuation of the asset is reduced proportionate to the expired life of the asset. Such decrease in cost is referred to as depreciation in accounting. The conceptual basis could be clarified with the help of an example. Suppose the manufacturing business firm buys machinery at a cost of rupees 10 lakh. It is assumed that the machinery will have a useful life of 10 years, after which it will be discarded as a scrap. Therefore, the depreciation on machinery will be spread out across its useful life of 10 years. The method of calculating depreciation may vary. Two most commonly used methods are straight line and written down value. Under straight line method, depreciation is evenly distributed across the useful life of asset. Hence, after the end of each year, the machinery will depreciate by rupees 1 lakh. That is rupees 10 lakh divided by 10. And at the end of 10th year, the book value of machinery will depreciate to 0. Now let's assume at the end of its useful life of 10 years, the machinery would be sold as scrap for approximately rupees 50,000. Therefore, the depreciation for each year will be calculated as rupees 10 lakh minus 50,000 divided by 10, which is equal to rupees 95,000. Under the written down value method, depreciation is calculated each year as a fixed percentage of the written down value of the asset. The written down value is the remaining value of the asset at the end of each year after reducing accumulated depreciation from original cost. For example, machinery purchased for rupees 10 lakh has a useful life of 10 years and the depreciation will be provided at 10% per annum at written down value. The depreciation will be calculated as cost of machinery at the beginning of first year will be rupees 10 lakh. Depreciation at the end of first year will be rupees 10 lakh into 10%. That is rupees 1 lakh. So, cost of machinery at the beginning of second year will be rupees 9 lakh. Depreciation at the end of second year will be 9 lakh into 10%. That is rupees 90,000. So, cost of machinery at the end of second year will be rupees 8 lakh 10,000. The process of providing depreciation for each year will continue like this till the end of useful life of the asset. The value of fixed assets net of depreciation is referred to as net book value. Hence, Under the written down value method, the amount of depreciation will reduce with each passing year as the value of the fixed asset keeps decreasing over its useful life. Whereas under straight line method, equal amount of depreciation is allocated to each useful year. Fixed assets normally include assets such as land, building, plant, machinery, and motor vehicles. All these items, with the exception of land, are depreciated. Land is not subjected to depreciation and hence shown separately from other fixed assets. Intangible assets. Intangible assets are the resources or things of value that have no physical appearance and are valuable to the business in the long run. They cannot be touched or seen but represent an intrinsic value without any material being. Some common examples of intangible assets include goodwill, customer relationships, intellectual property such as trademarks, patents, copyrights, etc. However, they are only recorded in the accounting books when they are purchased from outside. They are shown in the asset side of the balance sheet and have a useful life of more than 1 year. As they provide value to the business in the long run, the cost of their acquisition expires over such useful life. Hence, they are amortized over their useful life. Amortization is similar to depreciation with the intent of gradually reducing the book value of the asset to zero by accounting for the gradual consumption of the asset. Some intangible assets might have an indefinite life too, such as goodwill. Goodwill arises when a business firm acquires another business firm and the cost of its purchase is higher than the fair market value of the business. It happens because the acquired business firm has established a popular brand name or solid customer base, good customer relations, etc. Hence, the excess purchase price paid over the fair market value of the acquired business firm is termed as goodwill. When the intangible asset has an indeterminate life, it is not amortized but is periodically tested to see if the recorded cost of the asset has been impaired. Fictitious assets. As the name suggests, fictitious assets are not actually assets. Yet they appear in the asset side simply because of a debit balance when a particular account has not been completely written off. For example, preliminary expenditure of the company, promotional capital expenditure, etc. Current liabilities. Current liabilities are the short-term financial obligations of a business entity which are due for payment within the operating cycle of the business or within 1 year, whichever is less. These are usually incurred when the raw materials or services are purchased on credit. Current liabilities are settled either by using current assets or by the creation of other current liabilities. The ratio of current assets to current liabilities is known as current ratio or liquid ratio, and it helps in determining whether a business entity is able to pay all its short-term debts. Common examples of current liabilities include sundry creditors, bills payable, bank overdraft, outstanding expenses, income received in advance, provision for income tax, etc. Now let us discuss some important current liabilities of a business entity. Accounts payable. Accounts payable represent the sum of money owed by a business entity to its suppliers or creditors, usually for the goods or services supplied on credit. These are the monetary obligations of an organization arising in a short run. Generally, such claims are unsecured. When the business entity gives a written promise to pay money to a creditor for the purchase of goods or services used in the business or the money borrowed, then the written promise is called as bills payable or notes payable. Outstanding expenses. Outstanding refers to due but not paid. These expenses become due during the current accounting and hence are shown as an expense in the profit and loss account. However, as the actual cash payment of these expenses are yet to be done, they are also shown as a current liability in the balance sheet. For example, the rent of a building becomes due for the month of March 2021 but is paid in May 2021. Assuming the accounting period ended on 31st of March 2021, the rent of building for the month of March 2021 will be shown as an outstanding rent in the balance sheet as on 31st March 2021. Income received in advance. It is the amount received in the current accounting period but which is due to be received in the next accounting period. Since it is not recognized as an income in the current accounting period, it is treated as a current liability in the balance sheet until it becomes due. Provision for taxes. Every business entity is liable to pay taxes to the government on its earnings. However, taxes are not necessarily paid on the end date of an accounting period. The due date for payment of taxes usually lies in the next financial year. Hence, a business entity creates a provision for current financial year's taxes to be paid. The provision is reduced when the actual payment of taxes is done out of it. It is shown as an expense in the profit and loss account and as a current liability in the balance sheet until the taxes are paid. Long-term liabilities or non-current liabilities. Long-term liabilities are the financial obligations of the firm which are not paid off in the current operating cycle or current accounting period. These liabilities do not become due for payment within 1 year. The financial obligation in case of long-term debt lasts for more than a year. They are classified as secured loans or unsecured loans. When a long-term loan is obtained against the security or collateral of fixed assets owned by the entity, it is called as secured loan. On the other hand, an unsecured loan is not secured by any collateral. Usually, long-term liabilities include debentures and bonds, borrowings from financial institutions and banks, etc. Contingent liabilities. The literal meaning of the term contingent is subject to chance. Contingent liabilities are those liabilities that may arise depending on an uncertain future event. Until then, both the occurrence and amount of the liability are uncertain. If the event happens, there is a liability. Otherwise, there is no liability at all. Therefore, they are not recorded in the balance sheet but are required to be disclosed as footnotes to the balance sheet to provide a fair view about the affairs of the business to the users. Contingent liability can be defined as a possible obligation that arises from past events and the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise. A good example of contingent liability is a legal suit contested against the business entity for financial claim. If the case is decided against the entity, the liability arises, and in the case of favorable decision, no liability will arise. Hence, it is shown as a contingent liability in the footnotes of the balance sheet. Capital or owner's equity. Ordinarily, in a sole proprietorship firm, the owner's equity constitutes the capital contributed by the owner into the business. However, in case of a company, the owner's equity section of the balance sheet is divided into two parts. Number 1, the share capital representing contributed capital, and number 2, reserves and surplus representing retained earnings. The share capital is the capital contribution by the shareholders or owners. In case of a company, share capital is the joint stock predetermined at the time of registration, which is known as the authorized capital. It may consist of either equity share capital or preference share capital, having preferential right to fixed dividend and repayment of capital at the time of liquidation or both. The share capital is divided into equal units or shares. The authorized capital need not all be raised at one time. That part of authorized capital which is issued for subscription by the company is referred to as the issued capital. Equity share capital and preference share capital. Equity share capital is also called as the residual capital, as the equity shareholders have the residual claims against assets of the company at the time of liquidation after all the claims of creditors and preference shareholders have been met. Ordinary shares or equity shares have no preferential rights with respect to either repayment of capital or distribution of profits. However, equity shareholders possess the voting rights in the decision-making of the company. The dividend distribution to equity shareholders depends upon the profits earned by the company during a particular accounting period. Equity shares are also not redeemable. Preference shares, on the other hand, are so called because they have some preferences over the equity shares. These preferences relate to repayment of capital and payment of dividend. In the event of liquidation of the company, remaining assets after the payments to creditors are first distributed to preference shareholders and lastly to equity shareholders. Similarly, in the event of dividend distribution, the preference shareholders are paid first at a prefixed dividend rate. Preference shares could also be made redeemable after a specified period. Reserves and surplus. Reserves and surplus are the accumulated earnings of a business entity retained over a period of time and not distributed amongst shareholders as dividends. In other words, when a firm starts its operations, it has no retained earnings. Reserves and surplus normally arise out of profitable operations. Loss incurred by a firm reduces its reserves and surplus. Let's say if a business firm earns a profit of rupees 1 lakh in the first year and decides to distribute rupees 40,000 as dividends. The reserves and surplus at the end of the year will be rupees 60,000. Now, in its second year of operation, if the firm makes a loss of rupees 25,000, then the retained earnings at the end of the second year will be rupees 35,000. Retained earnings or reserves and surplus are in the nature of earned capital for the firm. In some cases, some part of reserves and surplus can be allocated for specific purposes. These are called as specific reserves. Specific reserves can neither be distributed nor be used for any purpose other than specified. Only non-earmarked or free reserves are available for distribution as dividends. Summarizing the position statement or the balance sheet. After learning about balance sheet, we observe that it is one of the most crucial financial statements as it reflects the financial position of the business and aids decision-making process of stakeholders. It is a periodic summary of assets, liabilities, and owner's capital as of a particular point in time. This statement in itself does not reveal anything about the details of operations of the business. However, a comparison of two balance sheets could reveal the changes in financial position of the business. A holistic understanding of the operations of the business would require an analysis of two other statements, that is, income statement, which is profit and loss account, and cash flow statement. We shall now discuss income statement in the next section. Relationship between income statement and position statement. The income statement mainly determines four elements, namely revenue, expense, income, that is profit or loss. Profit is reported when revenue exceeds expenses, whereas when expenses exceed revenue, loss is booked. It should be noted that the revenue and expenses must relate to a specific accounting period to determine the profit or loss of that particular period. Now let us recall the fundamental balance sheet equation which we discussed in the previous section. Assets equals to liabilities plus owner's equity. Here owner's equity signifies the net worth of the business and constitutes of the capital contributed by the owners and earnings retained in the business at the end of each accounting period. Hence, owner's equity equals to share capital plus retained earnings. The retained earnings explained in the equation is nothing but the profits earned by the business. These are the profits accumulated by business over the years. Hence, each year's profit is clubbed into retained earnings and shown in the balance sheet as a part of owner's equity. Similarly, if a business incurs loss in an accounting period, retained earnings will be negatively impacted in that year. Thus, we find that profit and loss account is an integral part of any balance sheet as it is an expansion of one of the terms of the balance sheet. Now let's summarize the unit. The process of accounting aims at providing the financial information about the business entity to the users with the help of financial statements. Financial statements are the formal end reports that summarize the business operations and transactions conducted in a financial year. These statements are prepared as per the accounting principles to generate systematic and consistent results. They are useful indicators of the financial health of a business entity at a particular point of time. It is vital to present the financial statements in a proper form with suitable contents so that the shareholders and other users of financial statements can easily understand and use them in their economic decisions in a meaningful way. There are three main financial statements of a business entity: the balance sheet or the position statement as at the end of accounting period, the statement of profit and loss or income statement, and the cash flow statement. The profit and loss account summarizes the revenues and expenses of an accounting period and shows the net profit or loss generated by the company. The net profit after payment of dividends shows the amount of retained earnings and hence links the profit and loss account with the balance sheet. Balance sheet is a periodic summary of the position of business. It is the statement of assets, liabilities, and owner's capital at a particular point of time. This statement in itself does not reveal much about the operations of the business, but comparison of balance sheets over a period of time could reveal changes in business position. Realistic understanding of business operations require reading and linking of all the three financial statements mentioned in the unit.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Vagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Uday Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.